Hey everyone, it's Zack Beck. With the real estate market experiencing surging prices, limited inventory, and a backlog of new home construction projects, many consumers are wondering whether we're in a housing bubble, and if so, when it's going to burst. People look back to 2006 and they see some similarities. There was historically low interest rates, prices were surging, people were getting into bidding wars, and people had this unshakable belief that prices would continue to rise no matter what. Unfortunately, when the bubble burst, it had tremendous effect throughout the economy. Between 2006 and 2014, nearly 9 million families lost their homes due to foreclosure and lost a total collective value of over $7 trillion because real estate prices dropped by 30%. So what I want to do in this video is break down in detail whether or not we are in a housing bubble in this current moment, the likelihood of prices coming down in the future, and what you should be doing right now to effectively position yourself to achieve your long-term financial goals, hopefully of home ownership. So let's take our time, dive in the details, and jump into it right now. As previously mentioned, the housing market is on fire right now. Prices are surging in large part to what has happened over the last year due to the pandemic, where people have this pent-up demand to go and purchase homes. Basically, a seller can place a for sale sign in their front yard and have offers just come pouring in. And this is also caused in large part to the low interest rates that have been issued from the Federal Reserve. The emergency actions that were taken by the federal government due to the pandemic caused interest rates to come down to near zero, ultimately affecting what mortgages were doing as well. So you can in effect get a 30-year mortgage at almost less than 2% in certain circumstances, and that's going to generally cause you to actually be paid money to have that loan over time because inflation eats away beyond 2%. So from that perspective, it's important for us to bear in mind that this is a very unique circumstance that we're encountering that is generally a bit different than what happened in 2006. What happened in the previous housing market bubble is there was very loose lending standards. Banks were giving out loans to pretty much anyone who wanted them to be able to purchase a home, irrespective of their income level and their ability to pay the loan off over time. In addition, these were variable interest rate loans, meaning that as soon as the interest rates were able to be changed, they would be. So someone could come in and get a loan at maybe 3%, but then that would actually turn around and turn out to be 15% just a few months later. So this caused some of these prices for people to be unaffordable, and people foreclosed on their homes as a result. And this was done system-wide, which ultimately led to the Great Recession that tanked the global economy. So there's a very different approach now because of new regulations that were put in place specifically because of that housing market crash. One of the things that has changed is we have much tighter lending restrictions right now. Generally speaking, you need to put 20% down on a home, and you're supposed to be able to prove your income over the last 2 years. You can also put 3.5% down if you do an FHA loan, or you can do 0 down if you do a VA loan. But the majority of consumers are encouraged to put 20% down, and if they don't, they actually have to buy mortgage insurance. So there's much tighter restrictions when it comes to actually being able to purchase a home, and lenders are much more hesitant to give money to people who cannot afford it, and that is causing a very different dynamic in our current housing market. During the previous housing market crash, foreclosures were the most significant issue that occurred. Nearly 9 million American families went into foreclosure, losing a total of about $7 trillion throughout the housing market. This was substantial and once again caused by variable interest rate loans that allowed people to not be able to afford their monthly mortgage payment. The difference now is that obviously during the pandemic, the federal government stepped in and they actually provided mortgage forbearance, meaning that people could delay paying their mortgage interest rate and also pay their loans at a later time without incurring a substantial fee or effectively losing their home. This basically has tagged on additional months onto the end of the loan, so someone's not going to be hit with a bill right when they come back out of the economy reopening. So things that you want to take into consider that are very different to the previous housing market crash is that with mortgage forbearance, it's less likely that people are going to foreclose on their homes, and therefore we're going to have less inventory on the market, which will keep housing prices higher. So this is something that is very different than what we had previously, and this is important for you to consider if you're thinking about purchasing a home in the future. One significant difference between the previous housing market crash and the current situation that we're facing is that homeowners currently have a substantial amount of equity in their homes. And now with new vehicles like home equity loans, people have the ability to access capital if necessary. And that is thanks in large part to because of the systemic growth that we've seen in the housing market over the last decade. Even coming out of the Great Recession, housing prices have continually steadily increased, and they've gone parabolic over the last year. So people have a bit more equity, therefore they're not as cash strapped, and they're less likely to be able to default on their loan or go into foreclosure because they have a bit more flexibility when it comes to their finances. This is very different than what we saw happen in the previous housing market crash, crash, where the housing market across the board, all of the prices started falling down. So you're going to see a very different dynamic that actually led to the housing market bubble crash back in 2006 and 2007 to what we're encountering right now. And the last thing you want to take into consider when thinking about whether or not this is a housing market bubble and if it's going to crash is that we have a very different approach to where we're seeing housing market price growth over the last period of time. We're seeing prices steadily increase. Obviously, the last year has been an anomaly and we saw prices go parabolic, but they are steadily increasing at a normal rate. Generally, you're going to see about 3 to 8% overall return when you're looking at a real estate price. So if you're seeing that on an annual basis over the long period of time, we're going to see prices continue to steadily go that direction. This is very different than what we saw previously, once again with loose lending standards, people foreclosing on their homes, and people not having the ability to afford their mortgage payments. And so when you see that more homeowners have equity, there are more strict lending approaches when they're actually having to prove their income standards, and then we're seeing steady housing price growth over time, it's far less likely for us to see this significant drop like we did back in 2006 because the rug is not going to get pulled out from underneath everyone. So for you to think about this for your perspective of actually looking to purchase a home in the future, you really want to be wise about thinking through whether or not the housing market is going to crash. Personally, I think that it's going to slow down a little bit. It's going to be steady over time. The housing market is not going to overall decrease substantially like we saw back in 2006 or 2007, but you might get a better value home for something that you would have been paying for during the 2020-2021 timeframe. That is because new projects are actually coming on board. Interest rates are going to remain relatively low through 2022 to 2023, and as a result of that, there is probably going to be the sweet spot of time when you could actually go and purchase a home that's a better value, even though it's still a high price, because you're getting a low interest rate, but you're getting a better home, and preferably you're not going to be put into a bidding war like we saw happen over the last year, where millions of people were competing against one another to move to more remote areas. But now with the economy opening up, people coming back into cities and more metropolitan regions, it's far less likely we're going to see that situation occur again because the overall considerations with the pandemic have subsided, even irrespective of some of the variants that are out there. And overall, I think that's going to be a good forecast for the housing market for those who are looking to wait just slightly longer to time it accordingly. With all that being said, I'd like to thank you for watching the video today. If you wouldn't mind, please tap the like button for the YouTube algorithm. Help push this video to other people who might need to hear it. Furthermore, if you have any questions, please comment down below. I'd love to interact with you, get to know you, do any research on your behalf so you can make well and wise informed decisions moving forward. Furthermore, if you wouldn't mind, please subscribe to the channel. That would mean a lot to myself personally, as I do everything I can to create positive content that makes a positive impact in your life by encouraging you and myself to lead lives of meaning and purpose, all while maintaining balance and moderation. And if you do subscribe to the channel, please tap the notification bell. That will notify you every time I post a video, which I do on a weekly basis. Once again, I'd like to thank you for watching the video today. I hope you have a wonderful day. Talk to you next time.